So there's a natural interest for multiple reasons in what's ahead for energy stocks and the rebound that they had coming off the constriction associated with the COVID lockdowns. And that not only is logical, but it also has in it some nuances that are good to understand. One part of that is that the COVID constrictions to the economy from the lockdowns was effectively an unprecedented phenomenon, and globally as well as domestically. And in that, as you will recall when you think back on it, there was a lot of fear that we would have no recovery, or a very U-shaped recovery, or maybe a W-type recovery, and not just in energy, which is, of course, when you say energy, despite any yak that people might want to do, for all intents and purposes, energy is oil, natural gas, the high-volume carbon products. Domestically and globally, to a rounding error, the other things are a tail on the dog. The dog is fossil fuel. And in that, whether it's oil or other commodities, oil is thought of separately than other commodities, which are often lumped together because oil is so big. But they're fundamentally similar in that the need exists to meet demand for plant capacity. And like lumber and like steel and like quite a few other commodities, the producers overreacted, not expecting the fast bounce back in that V-shaped stock market recovery followed by economic recovery that came so fast. And in shutting down that capacity, you can shut down capacity, whether temporarily or permanently, much, much faster than you can open up new capacity, whether it's reopening a shut down plant or creating a new greenfield operation from scratch. If you want to open new oil operations, it takes you a fairly darn long period of time, and same with many other commodities, 2 to 4 years at a minimum. And in that, they didn't have enough capacity to meet the fast rebound. And what that did was, of course, allowed prices to go through the roof. And as prices went through the roof, that's really the driving feature for energy profitability, and the stocks do real well. Now, with the economy in America, not globally, back to where we were before COVID, growth will moderate, and with time, at those higher prices, there's incentive to add more plant and capacity from all of the varied and very diversified producers that exist. And as that happens, that'll moderate pricing, and that'll moderate the potential of the energy stocks. I'm not saying that energy stocks will do badly, but I'm saying the relatively strong performance of energy stocks from late last year will not and should not be extrapolated into the future. They will act more like the traditional value plays that they were before, with very moderate growth rates and slackened profitability from competition than they have in the interim period where they benefited from those fast rising prices that added to their profitability in the short term. Subscribe to the Fisher Investment YouTube channel if you like what you've seen. Click the bell to be notified as soon as we publish new videos.